Hey guys, welcome to this week's Money and Investing Show. This week we are tackling politics and property. It is a hot potato right now. It's top of the headlines that are out there. Make sure you take note of some of the key flags that I'm going to raise in this broadcast. It could just save you from taking some serious bark off with what we've got coming down the pipe. Hey guys, welcome to this week's Money and Investing Show with me, your host Andrew Baxter, and as always my offsider and co-host Mitch Olarenshaw.
Thanks for having me on the show. Looking awfully dapper today, Mr. Baxter, and to get you rolled up, I love getting you rolled up, as we know, we're going to chat about the property market and specifically property market politics. Big episode.
I think I must be becoming a cranky old man. It gets easier to do this for you, doesn't it?
You did turn 85 last week. Happy birthday, by the way.
That was in dog years, thank you. Yes, indeed, the politics of property, and I guess the big topic, you can't get away from it at the moment, is obviously housing affordability. You know, it's a hot potato, wherever you really look in terms of seeing the massive surge that we've seen in the property market. People then go back to, well, what about housing affordability and the people that it impacts? So, no question about it, it is. And we've talked a fair bit about property. I think the last one we did was just before the end of the financial year.
Yeah, 27th of June, episode 26. For any of our viewers who haven't watched that, it's about first home buyers specifically, and it covers a lot on sort of unaffordability of the property market. Can we have a quick recap of that?
Well, I guess, if you look at property buying, 64% of first-time buyers are getting a loan from the bank of mum and dad, gift, however you want to dress it up.
Bankroll.
To help them with their deposit. And the average amount of what that gift is just around about $100,000. So it's a pretty decent lick.
It's a good start.
I'm looking down the barrel with 5 kids at a fairly expensive bank of mum and dad laying some money down. But look, the reality is that's all well and good helping someone get to the deposit, and people are citing that as a reason why the market's run away. But the real issue, of course, is that interest rates are so low, be they artificially low, they are very low, and that's really what's been propelling the market. So, we've seen a surge in property values. For the first time, I think, it's certainly in my memory, it's everywhere. Regional, city, north, south, east, west. It's been ubiquitous. It's been across the board, which is quite unusual. You normally see pockets or things like, for example, during the mining boom, Port Hedland, going berserk.
Sure.
But this has just literally been everywhere.
And, it was only a number of years ago, we're talking about Sydney being the runaway market. Now it tends to be pretty much all of Australia. And at the time of this broadcast, to add to that, we know that NAB's just come out with a report saying that they expect 20% growth in property market over the next 2 years. It's a pretty big
From the
estimate.
Sydney market, yeah. And look, I think they might want to revise that given the current circumstance and the lockdown that we're seeing, and that's a huge risk. We'll talk about what that risk looks like, I'm sure, as we go on through. But we are looking down the barrel at a fairly lengthy lockdown in Sydney, which needs to happen in order to rein things in, and I think that will weigh quite heavily on what I would consider to be a massively overvalued property market.
Absolutely, and no wonder it's so tough for first home buyers to get into the market. Shifting that forwards now, AB, to sort of draw that into our topic of conversation today. Let's chat about investment properties, because there's plenty of people out there probably over-gearing at this point in time, given that they're just buying and buying and buying, right?
There are. I mean, the investors have been cited as the reason why this market's run away. And I think if we sort of go back a step for a moment, property ownership is not a right. Let's just put that out there, and it's going to be controversial. Some people will hate me for saying it, but it is not a right. If you want to own a property, there are serious steps that you need to take. It's something you've actually got to want to do. You've got to save money for the deposit. You've got to be able to put down a reasonable amount of deposit. And parents helping their kids, that's great. We all want to help our kids. You don't want to see them walk through snow to school barefoot. But at the same time, rolling out the red carpet, it unfortunately can come at a cost, and we'll talk about what that may be as rates move up. And so, having the right to own a property is not your right. You need to make it a goal and work toward that, as opposed to, hey, I'm 25, I should better buy a property. Oh, I can't because
I haven't saved.
I've spent the last 5 years, enjoying experiences in life, a car and some flash clothes and some great technology around the house. And, and it's interesting, I get to meet under different circumstance to that which we're in now in the COVID environment. But if we go back to, the seminar industry, and I've traveled all around the world doing events around the world, and you see the same story over and over again, and it's a huge generalization. At the same time, though, it's what I have seen. So I have to talk about it because, it's what I've seen out there. And you'll talk to someone and say, look, love your program, love to do it, I can't afford it right now. And the first thing I normally say is, do me a favor, take out your phone. And invariably what comes out of the pocket is the latest top of the range $1,200 iPhone.
The iPhone 12 or something.
And then let's have a look at your wallet, and there's a Louis Vuitton wallet and belt and some nice Gucci pumps or whatever it may be. There's a bit of a story in there, but you get the idea. And it's like you could afford it, but your life choices are that the things that you're showing me right now are more important to you to have than the hard grind of saving up, which is not very sexy. To get yourself into the property market.
Well, that 4 or 5 grand spent on designer clothes could have gone towards your deposit quite nicely, right?
Yeah. Not going to get very far with a 4 or 5 grand
no,
deposit.
but you get the idea.
It's not even going to get your stamp duty now, which is
Not at all.
a huge thing, which is another thing that investors seem to, or people seem to overlook, is the huge cost of stamp duty, which, let's face it, we're talking about politics and property. Stamp duty should be abolished. It's a free swing for the various states to gouge obscene amounts of money for literally stamping a piece of paper. It has to go. Good luck with the New South Wales getting that pushed across the line and getting it replaced with land tax. They're struggling to get that through Parliament, of course, now as well, because people are seeing it for what it is. But the reality is, owning a property is not a right. It's something you've got to work toward. Around 2/3 of Australians own a property, and quite a significant number own an investment property. So what we're talking about in terms of affordability is now a minority issue. It's not the big issue. 2/3 of people are in the market. Market goes up. Happy days for them. For those that aren't, what are the reasons you're not in? Haven't saved, don't earn enough, haven't had job security, don't have a job, or it hasn't been a priority, or you can't afford to buy in the suburb that you want to live in. And we've talked about that massively. You buy where you can afford, and over time you parlay that into ultimately where you want to get to. So rather than, you might be living in Blacktown as opposed to in Bondi, but that's what you can afford and you live to your budget.
Sure.
So we've talked about that quite a lot. I think, as you say, podcast 26 is where we covered that.
Yep.
What we're seeing in the market right now, the political hot potato, how can we politicise property? Quite simple. Labour Party yesterday, Federal Labour Party, came out and did an absolute 180-degree flip, and their whole platform for the last 2 elections was, let's get rid of and abolish negative gearing and concessions on capital gains tax in property. They've dropped that, and I can foresee the only reason that Albanese has really done that is it's not a mandate that you're going to get elected upon, and this is pure Donald Trump politics.
Donald Trump politics. Pause that for a second here. Really?
Yeah, Donald Trump politics. Find out what people want
and give it to them.
And just make statements that support that and build your policies around it. And it's very, very clear for the Labour Party that the abolition of negative gearing is not something that's going to get you elected. In fact, if you dive a little bit deeper, negative gearing is something that would hit the heartland of Labour voters, teachers, people that work in healthcare, for example, 2 primary groups that are significant in the negative gearing space. And they're there because it's really the only way they can get any kind of tax deduction from a government paid job. So you're shooting your own voting public in the foot by doing that. So they've flipped over, and I'm guessing, and I'll put it out there, I'm not a betting man, as you know, but I'll bet you the federal election as it comes up will be all about healthcare, and they'll be arguing, you did a bad job of managing COVID, we would have done far better. They've realised they can't do it on the part of tax. If you look at Josh Frydenberg's budget, there was nothing in there. There was spending left, right and centre, so there was nothing you could really unpick there. So this will be a budget, an election campaign that's about healthcare. So they've jumped ship on the negative gearing is the bottom line. And
just to rewind that, or maybe for any of our listeners who don't actually know or understand what negative gearing is, can you explain that in pros and cons?
So negative gearing in its true sense is that the cost of holding a property, servicing the debt, your landlord insurance tax, all the different depreciation, different things that you can claim in there, your rates, are, when you total them up, more than what the rental income might be. So overall, the property owner is at a loss by holding that property, and therefore they can get a tax deduction on that amount that they're losing on there. Negative gearing doesn't really work when interest rates are 2%, because typically the biggest source of a loss on a property is the cost of servicing the debt. But when you look at interest rates that are maybe 2 or 3%, every million's costing you 30 grand.
It's very cheap.
So that significant. You'd be hard pressed to find negatively geared property. Most stuff will be positive, purely and simply because of the low levels of interest rates.
So with interest rates being so low, we're obviously seeing more people buy more houses, right? Which is then subsequently driving up the market. If we did see interest rates subsequently rise, which they should, right? What kind of effect are we going to see?
Look, I think that outlook is actually quite gnarly for a number of reasons. And if we just recap, property investors get a pretty hard time. I don't have a predisposition towards property or shares. I've made a lot of money with both asset classes. I'm in both asset classes. I love both asset classes. But as a professional investor, it's the numbers, the metrics, which I look at to help me make my decision, as opposed to an emotional decision, like, oh, I'm more comfortable with property because I can see it, which is something we often hear. With shares, just a bit of paper, or shares are more volatile. You know, there's the argument either way. We'll talk more about that too, I'm sure. In regards to where we are in the cycle right now, we're seeing properties massively overvalued. And if you take shares, we talk about PE ratios. That's the price of the share divided by the earnings. And it gives you a ratio and you get a gauge on whether the share is expensive or cheap.
Valuation, right?
Valuation basis. If we take that PE ratio and look at a property, now I'm going to pick a time frame that isn't a curve-fitting time frame that happens to suit our argument today. Let's go back to pre-Sydney lockdown. Okay, and let's talk about May of this year. And pick a decent inner city suburb. We're going to talk about Elizabeth Bay, which is a lovely place just on the eastern suburbs, great little spot. Now, the median price of an apartment there is $1,010,000 according to RP data. So
pretty expensive.
The average weekly rent is $473. So if you annualize that, your annual yield is about 2.4% gross. This is gross. This is before you pay all your holding costs, etc. Right?
So what's your real yield on that after costs?
It's barely a yield on that asset.
1%, something like that.
But I want to just draw the comparison in terms of valuations for a moment. So if you're earning 2.4% yield in terms of income gross on something, effectively the PE of that property, if we were to use a share term, is 48 times earnings, which, you know, if you looked at that, you'd laugh at a stock that had that kind of multiple.
That's afterpay like.
Well, it is, but when you're buying afterpay, you're buying that technology breakthrough and disruptive technology going into the future and changing the banking system forever and a day.
And you can also invest with a very small amount of capital as well.
Whereas how much more upside is in that market? Now, NAB say 20%, but I think that was pre this lockdown. Those statistics would have come out. There's always a lag factor. But we're also looking to see, number one, New South Wales, which is, you know, to all intents and purposes, a third of our economy in lockdown. So that is going to have some economic impact. And there is, at the moment, certainly a yawning gap in terms of federal government support there. There's no talk of JobKeeper 3, which I happen to believe is the right thing. And so you're going to see this weigh fairly heavily there. So, you know, seeing some volatility and weakness in that property market wouldn't surprise me. Looking at interest rates, they are starting to increase. Now, not in terms of the headline rate, which most people would look at, but if you've gone off a fixed rate, say you've had a 1 or 2 or 3 year fixed, a honeymoon period, so to speak, and you've now moved on to a variable rate, that variable rate would be at least a percentage higher in most cases. Now, there'll be people that listen to this and pull me up, oh, it's 0.8 or it's 0.7, but the general trend of what I'm talking about makes sense. The variable rate is higher than what you're on, which means you're now paying 20-30% more in terms of your repayments, and this is with interest rates staying flat. We've got inflation pressure. The reality is that real inflation is probably significantly more than what the statistics would show right now.
CPI figure, sure.
I'm not sure if you believe me on that. Go and see how much it costs to fill your car up with fuel. Have a look and see what your electricity bill was. Look at the 8% jump you had last year in your private health cover. Have a look at the cost of building materials, up 30%, for example, just for the last 6 months. And you're going to start to get an idea that there's inflation that's really out there, which is because the economy is awash with cheap money. So you're going to start to see interest rates go up. Now, we mentioned about the bank of mum and dad earlier on helping their kids out. Here's $100,000, here's your deposit covered, happy days, move in, legacy, helping your kids move forward. The challenge is for the bank of mum and dad, you've got $100,000 now in that property, albeit under the name of your kids. When interest rates start to move up, your kids that didn't have enough money to save up for a deposit in the first place are now going to be looking at increasing serviceability costs on those loans, which they may or may not be able to meet. We're not seeing wage growth at the moment, even though we've got some inflation, and it's unlikely we're going to see that for a little while, particularly as we've gone back into lockdown. And as a consequence, you can see the bank of mum and dad are going to have to start, you know, shelling out some cash to help support the weekly or monthly payments for their kids as well. Probably not what they signed up for, but nonetheless will be an outcome that they face. Because if you have rising interest rates, which as sure as eggs are going to happen. You know, I'm an economist, I've been in this game for a long time, I've been through numerous market cycles, it's coming. And you maybe see a bit of a tapping out of a property market that's trading at a PE of around about 50 times earnings, if you look at it in that language.
It's a lot.
With a third of the economy in lockdown and no federal support coming over the horizon to prop it up, doesn't smell of roses when you look at that as an outlook. And I think, you know, it is a very difficult political hot potato. Looking at some of the transactions that have happened, people have gorged themselves, and we've talked about this. Don't borrow what you can, and look, let's just explain the lenses I'm coming through here. This isn't a beat up session for people. It's the last thing I do is waste your time or mine doing that. The lenses we look through for our clients from a moral perspective, is to make sure that we do everything we can to protect them from risk. Now, we talked, I think it was in that June podcast, don't borrow what you can borrow what you can afford.
Sure.
And there's a big difference in there. So if you can, if you borrow 2/3 of what they're going to lend you, you're giving yourself a bit of a cushion there, as opposed to trying to gear up too much. But that greed gland as human beings that we've seen with this market running away, hey, this is a one-way bet. No market is a one-way bet. Let's get into this now. Let's stretch ourselves where money's cheap. It's cheap to borrow. Let's buy that bigger house. All good so far. Because if it's a bigger asset and the market's running up by 20% according to NAB over the next couple of years, I don't think it'll happen, but let's say it does. Let's get a bigger asset so the denominator's bigger, we'll make a fortune. Problem is, if that prophecy doesn't come true, if the markets slow down, if not fall, and interest rates are going up and your cost of servicing that debt has gone up through the roof, literally, on a property that's going back the other way, you run the risk of being in a negative equity position, which is a terrible, terrible space to be in, where the bank is going to say, Mitch, you got to put in some more cash here, otherwise we're going to foreclose on your property. Now, bear in mind, from a first home buyer perspective, for example, you couldn't afford to buy the property without the good grace of mum and dad in the first place. Where are you going to get another 50 or 80 grand to throw in there to get the equity back where it needs to be to satisfy the banking system?
So would it be fair to say that we're risk on, AB?
I think it's huge risk on, and yet people blindly look at this and go, oh, property is great, it doubles every 7 years. It doesn't double every 7 years. Show me the statistics on that. It doesn't do that. There are cycles in there, and we're at the top of that cycle. There's no organic growth in this market. The population growth isn't there. We haven't got overseas buyers coming in. We've got no migrants coming into the country at the moment, so that demand isn't necessarily really driving things. The investment markets have moved that around. The migration of people out of being in an apartment in the city where they've got to work from home to being in a house in the suburbs has been largely one of the migratory factors for that, and also the migration from cities in general to regional areas. I've seen this in my backyard at Byron. The number of people that are up from Melbourne and Sydney over the last couple of years, or the last year or so, is insane. And they go, I can work from home. I don't need to be down there. I can fly down from Ballina and head down as and when I need to. And I can work from home up here. So there's been a huge migration factor that's pushed those areas. And of course, it's leaving a vortex behind it. Now let's talk about investments. Investments are about two things. They're about capital growth, well, they're about three things. Capital growth, they're about income, and they're about managing risk. Now, the property play right now is a pure one-way bet on capital growth. That is it. Because if you look at a yield of 2% gross, 50 times PE if we use a stock market analogy.
You better hope it's going up.
You better hope it's going up, because the yield on it simply isn't commercial for the risk. And the risk, of course, is that you get a pullback in that market and all bets are off.
A lot of people forget there's also CGT, right?
CGT on an investment property, again, is something that Labor have walked away from trying to abolish. They didn't want to see the concessions. And to be clear, primary place of residence, no capital gains tax, rightly so, because you buy your house in after-tax dollars, you shouldn't get taxed on it again. Maybe some people think you should, but that's probably not how the game should be played. On an investment property, however, there is 50% capital gains tax, depending on your entity and structure. Of course, different if you're in super doing that. But again, this isn't about giving tax advice. The reality is there's also a capital gain on that, which sweeps across quite conveniently into the government's coffers. So there's a vested interest in seeing a market rise, because stamp duty, lots of transactions, and capital gains tax on those sales when there's a profit flows into the government's coffers. So there's a vested interest there. There's risk on right now, and I think it's something you cannot yell loud enough from the rooftops to people, is to not get carried away with this. Buy what you can afford, not what the bank is going to lend you. Don't buy on an emotional basis, buy on the numbers. And if you want to have a directional play, it's rather like, I meet people all the time in the trading space, I own gold. Oh, great, what are you doing? And they actually own physical bullion. And the reasons for it usually is that they may be a conspiracy theorist, or they just don't know that there are better ways of getting exposure to gold. Now, the problem with buying physical gold is you've got a pure directional play. It either goes up or it goes down. There's no yield on it, and you've got quite a substantial amount of cost either to buy it and or store physical gold. Property is becoming the same thing, with the yield dropping, as we've seen. It's now a one-way view that you're only going to make money if prices move up, and I think that engine is starting to sputter. And with the lockdown that we're seeing in our major economic hub in Sydney, this is something that people need to hear and see loud and clear. Well, that's Sydney, what about everywhere else? There will be a ripple effect that will spread up, because of course investors, if you're starting to do it a bit tough, are going to start culling other properties they might have in their portfolio if they're stretched, particularly if there's no rental growth there. And they're not going to see wage growth to a level that's going to support the kind of growth you've seen in property prices. It's just not going to happen.
Doesn't sound great, and there's a lot of moving parts there, AB, but that provides, I think, a really good framework around where we see this going. I guess capital growth is a two-way bet. It's either going to go up or it's going
Red
to
or
go
black.
down.
I mean,
It's red or black, right?
I hate those odds.
Yet yield and income is something that can be generated very easily through the stock market, which is our bread and butter. So rather than talk about the red or black bet on property and capital growth if there's no yield, how do you get some yield?
Okay,
I said I was going to rile you up.
Yeah, well,
Postman always delivers.
You certainly do. You haven't let us down there. And again, I mean, what I'm saying here, I think is common sense. I mean, I'll hold that thought for the conclusion. If we compare a property and a share transaction, so we've talked about Elizabeth Bay, $470 a week rent. Let's take BHP. There's a trade I actually put in our newsletter and advisory stuff 3 weeks ago. BHP is trading about $48. You could buy BHP. What's the risk on with BHP? Well, it sells iron ore, and it sold more iron ore this year than it has in its history. It's got a massive dividend coming down the pipeline. The share price already moved up about $3 or $4 in anticipation of that. And you could generate around about 2.6% income for just 28 days. So instead of a whole year of rent,
28 days?
you can generate the same dollar return in 28 days. Risk on? Not really. Iron ore price has gone ballistic. Company's going to be paying a big dividend, which gives the stock a terrific tailwind going into its earnings coming up around the corner. And better yet, for those people that are a little bit nervous, and you cannot do this in property, now the price has moved up in the 50s, buying some protection and insuring these shares for what you paid for them so that your downside is effectively zero is actually relatively cheap right now too, based on getting in at $47. So you've got a situation where if you're savvy and you know what you're doing, you've got the ability to generate a year's worth of property income in 1 month in the bluest of blue chips. It's got the strongest of tailwinds, and if you're half savvy, you can eliminate your downside risk by buying protection. That to me is a smart investment. It ticks a lot of boxes. There's income, there's capital protection, there's a very strong fundamental story versus a very questionable fundamental story with no downside protection and barely any income to speak of.
And very low barriers to entry, which is great for someone starting off as well.
Start off with a small amount of money. You can start off that BHP trade with less than what your stamp duty would be to buy that property, which puts it into comparison. And do we have an axe to grind? Of course, we're on our path. We do what we do. But our overarching, I guess, inner DNA within our business is to steward our clients safely through trickier times in the market. And we are in for a rough ride. And remember where you heard it first. And I might not be right this month and I might not be right next month, but you're going to see this come through to fruition over the next fairly short period of time. I'm talking 5-10 years down the line, over the next fairly short period of time when things genuinely do start to cut up rough. And unfortunately, a lot of people out there just simply aren't. They're caught into the headline to headline, let's get a property, it's one-way bet. And the reality is it can be pretty gnarly. And I actually had a conversation with my father-in-law over a wonderful glass of red on Sunday night.
Was it a bottle of Grange? I know you've got a few of those.
Yeah, it wasn't a Grange this time, no. It was actually a Henschke. So it was a Hill of Grace. Very
Not bad.
Nice.
Good place to start.
Great place to start. Nicely decanted too, I might add. The conversation we had was in their circumstance, and my in-laws were both teachers. And so they went down the typical route to get a tax deduction, own a block of investment or an investment property, which they did. They were living, I think, in Dubbo at the time. They didn't particularly want to stay out there inland, but that's where, as a teacher, they got deployed in the first place. So they had their primary place of residence where they could afford somewhere. And then they had their investment property, ideally where they were going to live. Why? Because of the deductibility that's available there, negative gearing. Now, interest rates for that period of time were actually ratcheted up to 18%. Now, we're talking about people, interest rates 3%, 4%. 18% when this particular scenario happened for them. And so they could have gone a number of ways. They could have folded, defolded, lost the investment property and been behind the eight ball. What did they do? They both had 3 jobs. They're both teachers. They taught swimming, and they both taught at the gym. In fact, my mother-in-law was a dance instructor, and my father-in-law was teaching at the gym, and they were both swimming instructors on top of teaching 5 days a week at school, 6 days a week at the swimming pool, as in after work and on a Saturday there, and worked their way through it. Now, how many people, as we move into this area of financial distress, and look, yes, we're in lockdown, so perhaps that does limit in some ways the ability to generate different types of income. But that's really a story because it doesn't have to be that way, as we well know. How many people in today's world would, if things cut up a little bit rough and got tough, would go, government, give me a handout, I need JobKeeper, or I need some support to get through these tough times, or a moratorium on paying my loan, or I only get 3 jobs and just keep my head above water by working hard. And I think there's been a huge shift in our work ethic and our individual accountability. We look to the government to provide a safety net, as we are now with JobKeeper again. Where is it? Well, 2 months ago, everyone was saying, oh, you should have cut it earlier. It was wrong. Too many people rorted the system. Now everyone's going, get it back. So you can't have it both ways. So that work ethic is slightly missing. And okay, if you're in lockdown, yes, you can't go and drive Uber, and you're probably not going to go and get a cash job doing window cleaning or teaching at a pool because people might not be out and about. But we live in the online world now. The internet wasn't even invented back then. There are so many things you can do as a side hustle. Stock market's our bread and butter on the side, in addition to your job at home. Maybe you've got an Amazon business or whatever it might be that you choose to do. There are more opportunities out there than ever before, but we've become a little bit soft as well. And this is a hard lesson. I know I'm not going to get a lot of popular comments on this, and I don't care, because our job is to help our clients steward the ship. Coaches win games, Mitch, cheerleaders don't. If you want a hug, this is not let me give you a hug. If you want a coach that's going to make sure that you don't get on the wrong side of what is coming over the hill, this is what I've just had to say.
Wow. I said I was going to roll you up, and then the postman always delivers. Thank you, AB. A lot in that.
It's a good sparring session. We've sort of got a couple of rounds in there.
Well, it's you sparring me just copying the punches at the moment. But sure, we'll go with that.
Float like a butterfly, sting like a bee. Thanks very much, mate.
No worries. Cheers, AB.
Cheers. There you have it, guys. Make sure you make a comment, like, and subscribe, and of course, hit the notification button, and we'll see you next week.